Well, hello everyone, and thank you again for joining us this evening. You know, you're all friends of mine. I see a lot of old faces here, and I see a lot of new faces. Makes me happy because it sees we're growing, and you know, a lot of the new generation are becoming part of Langlois Financial, and it really means a lot to us. So tonight, what I'd like to talk to you about a little bit is a tax-free savings account. And you might think, yeah, I know a tax-free savings account, but where most of you are familiar with them, there's a lot of details about that product that are sometimes misunderstood. And misunderstandings and misinformation can end up being very costly for you. So I want to go over the details with you of this product. And I'd like to start with the basics. So first of all, a tax-free savings account is simply an account where you can earn some money and pay no tax on the gain. And now, because the amounts withdrawn from your TFSA are non-taxable to you, they don't affect the amounts you're eligible to receive from government programs such as employment insurance, guaranteed income supplements, and OAS. And that's really especially beneficial at retirement, when other sources of income, such as RSPs and pensions, can reduce the amounts that you're available from these programs. Now, since 2009, January 1st, 2009, Canadian residents who are 18 years of age or older with a valid SIN number were eligible to contribute to a TFSA. Now, the TFSA dollar amount is indexed by the inflation rate, and that indexed amount is rounded up to the nearest $500. So, for example, currently the limit for this year is $7,000. And if we had a $2% inflation rate in 25 and 26, it's going to remain for the next year. But then it would increase to $7,500 in 2027. Now, your TFSA contribution room is going to be shown on your income tax return, on your notice of assessment, and it's made up of your TFSA dollar limit, which, as I mentioned, is $7,000 currently, as well as any unused TFSA contribution room from the previous year. And any withdrawals from your TFSA in the previous year will also be added to the contribution room for the current year. Now, the amount of contribution room added is always going to be equal to exactly what was withdrawn. And I want to point that out because, you know, for example, if you have somebody that's entitled to $102,000 into their TFSA, and they put it in, let's say this past January, but then in March they needed to withdraw that money, and they had to take out that 102. But the markets were doing pretty well, and it actually grew to 105,000. Well, what happens then? Your room that you have to recover into your TFSA the following year would be 105,000 because it includes the growth. Now, likewise, on the other hand, if you'd put the same 102,000 in, and then you took the money out in March, and the market wasn't doing so well, and it was worth 100,000, then the money that you have in space to return back to that TFSA next year would only be 100,000. Now, also, I want you to know that transfers from other institutions have no effect on your TFSA. So if we're transferring your TFSA from RBC to here, or going from here to somewhere else, it has no effect on it. Now, TFSA contribution room accumulates every single year. And you don't have to set up a TFSA or file a tax return to earn that contribution room. But depending on the type of investments held in your TFSA, you can generally withdraw the money at any time, at any place, and for any reason with no tax consequences, excepting things like guaranteed certificates like GICs. In that case, you would have to wait until that investment certificate matured before you could pull the money out. Now, there are many different types of investments allowed in your TFSA. You can put cash, mutual funds, segregated funds, guaranteed investment certificates. You can put securities listed on a designated exchange, bonds, certain shares of small businesses and corporations. Now, when you make a withdrawal from a TFSA, as we mentioned earlier, the amount withdrawn is added to next year's allowable limit. People who misunderstand this rule often redeposit the amounts in the same year they withdrew it, and that can lead to an overcontribution and a penalty of 1% per month. So you want to try to avoid that. So, for example, if you put the 102 in, and you took out 50,000, in your eyes, if you wanted to put that money back, it sounds like I haven't over-contributed. I still only put 102. But that's not the way the program works. That space is not available. You don't lose it, but you can't put it into the following January. And if somebody doesn't notice that, it could get you in a lot of trouble. We manage that at our office. we would never let that happen to you. Now, working with new clients, we sometimes find their accounts have not been set up for the most efficient transfer of TFSA assets at death. Many have been set up with spouses listed as beneficiaries, because that's the way we always think. I want my wife or my husband to be the beneficiary. That means that the TFSA amount over the spouse's limit will not be able to remain in a tax-free environment. And furthermore, any income earned between the time of death and the time of claim is going to be taxable to that beneficiary. And we recently had a case that was a client of ours that had one at a bank. And we were able to fix it finally, but it took almost 1.5 years to get it done. Nobody needs that. What we recommend is that spouses always be listed as the successor holder rather than beneficiaries. Because as the successor holder, the inheriting spouse can immediately become the owner of the TFSA upon death of the contributing spouse, and there will be no tax implications for the growth realized between the time of death and the time of claim. And it's also important to know that this money can be kept in the TFSA regardless of the inheriting spouse's contribution room. So that's a big deal. Having outdated and incorrect information can be harmful to you for your financial well-being. And at Langlois Financial, we take a lot of pride in our ability to provide our clients with the most up-to-date and detailed information. And we do this by educating ourselves and staying current on all the strategies and products in the financial markets. And we do our best to share current relevant information with you, evenings like tonight. Excuse me. There are brochures in your folders tonight about the TFSAs, and I want you know, you don't have to look at them right now, but you can look at them later on. And if you have any questions about TFSAs, you can always call us if you have anything you want to know anytime. And if you already have a TFSA with us, you know how well it's working for you. And if you don't have a TFSA yet, and you'd like to set one up, feel free to call our office and set up an appointment, and we can go over the details of it with you. And lastly, if you do have a TFSA elsewhere, shame on you, that's okay. But if you do, and you don't think it's performing to your satisfaction, feel free to give us a call. We'll review it with you and help you understand what you got going on. And if at the end of it you feel like you'd like us to manage it for you, we'll do all the work in order to make it transferable over to here. And that's about all of it on TFSAs.